Hello everyone, and welcome to today's presentation. I'm excited to share with you how to develop a robust trading system built on proven smart money concepts. Today, we'll explore a high-probability SMC framework that helps you pinpoint exact entry and exit points for the best risk-reward ratios. We'll also look at how to understand how large institutions approach the market so you can align your strategies accordingly. Additionally, we'll cover institutional top-down analysis, including high timeframe bias and low timeframe entries, and how multi-timeframe analysis plays a crucial role in applying smart money concepts. Let's get started. Mastering MTF analysis is absolutely crucial for aligning with the institutional flow and sharpening your trading edge. Effectively, the direction of the market is determined by the higher timeframes, or HTF, while the actual execution or entry points come from the lower timeframes, or LTF. If you ignore multi-timeframe analysis, you're basically flying blind and likely making random, low-probability decisions that don't have a solid foundation. Lower timeframes are where you find the best entry points, the precise moments to get in a trade. Higher timeframes, on the other hand, give you the big picture, the overall market direction. Think of institutions. They analyze the market from the top down. They use the higher timeframes to understand where the overall trend is heading, and then drill down to the lower timeframes for the exact spots to execute their trades. That's why multi-timeframe analysis matters so much. It helps you stay aligned with the market's flow and improves your chances of making smarter, more consistent trades. All right, let's dive into how each timeframe plays a crucial role in building a high-probability trade setup. Every timeframe acts like a different layer of information, and together they create a comprehensive picture. Starting with the HTF, or higher time frame, like weekly or daily charts, this is where we leverage smart money concepts to understand the bigger picture. It helps us determine the overall market bias and long-term trend. Think of this as setting the foundation for your entire trading plan. Knowing the dominant trend guides us in making aligned trades and prevents us from going against the overall flow. Moving down to the MTF, or medium time frame, such as H4 or H1. Here, we focus on identifying key market structures and high probability points of interest, or POIs. These are specific zones or levels where price is likely to react, and they're critical for our decision-making process. This timeframe allows us to pinpoint more precise areas for entry and confirmation, ensuring our trades are well-timed and aligned with the broader trend. Finally, on the LTF, or lower time frames like M15, M5, or even M1, we refine our entries. This is where the battlefield really comes into play, finding those precise points for entries and confirmations. It's about executing trades at optimal levels, where the probability of success is highest. So, by using this top-down approach, starting from the weekly or daily, then moving to H4 or H1, and finally hunting in on M15, M5, or M1, we create a cohesive framework. It helps us stay aligned with the overall market context while pinpointing the best moments to act. That's the power of understanding the timeframe structure in smart money concepts. It's about layering information, reducing risk, and increasing the likelihood of successful trades. Let's start by looking at some key institutional areas of supply and demand. These are crucial zones where big players are likely to enter the market, either buying or selling heavily. Recognizing these areas helps us identify major order blocks, those significant zones where price tends to react strongly. Next, we want to focus on identifying the optimal areas to buy low or sell high. These zones give us clear entry points, maximizing our potential to profit. Moving on, we have premium and discount zones. These are important because they help us confirm shifts in market momentum. When price enters a premium zone, it might be overbought, signaling a possible reversal or pause. Conversely, a discount zone could indicate oversold conditions, hinting at a potential bounce. Another key concept is the break of structure, or BOS. This tells us whether the market is in an uptrend, downtrend, or consolidation. Spotting these breaks helps us understand current market dynamics and adjust our strategies accordingly. Now let's talk about trend direction. This is ultimately about answering the question, should I buy or sell? The higher timeframe bias plays a vital role here. It provides the overarching fundamental direction for our trading decisions. If the higher timeframe shows an uptrend, we tend to favor buying. If it's a downtrend, selling might be the better choice. Understanding the HTF bias is critical because it aligns our trades with the bigger picture. It helps us stay disciplined and avoid going against the primary market trend. So, always consider the larger trend when planning your entries and exits. This is the key to consistent trading success. When trading, it is absolutely crucial to focus only on trades when the price is interacting with a strong higher timeframe point of interest, or HTF POI. These are significant levels that often act as support or resistance, and they can even serve as targets for liquidity. One key type of HTF POI is previous highs and lows. These levels are important because they tend to attract a lot of activity. Think of stop losses and pending orders that get clustered around these areas. This activity, in turn, attracts institutional players who are looking to capitalize on these zones. Next, we have liquidity zones. These are inefficiencies in how the price moves, areas where the market didn't fill orders smoothly. These gaps or inefficiencies often get filled later, making them prime spots to watch for potential reversals or breakouts. Then there are fair value gaps, or FVGs. These are essentially price gaps created when the market moves quickly, leaving unfilled orders behind. These gaps are attractive because they often act as magnets. Price tends to return to fill these gaps, presenting opportunities. Another important concept is order blocks. These are regions where large institutional orders were placed, and they often lead to significant price moves. Recognizing these blocks can give us clues about where big players are active and where price might react strongly. Finally, all of these elements, support and resistance levels, liquidity zones, fair value gaps, and order blocks, help us identify high-probability HTF points of interest. These are areas where institutions are more likely to react, creating lucrative opportunities for us as traders. By understanding and focusing on these key zones, we improve our chances of trading with the larger market structure and not against it. Now, let's talk about this methodical transition process. It's designed to help you avoid jumping into trades too early or reacting impulsively. Instead, you wait for clear institutional confirmation before acting. One of the key signals is confirming a structural break on the lower time frame, or LTF, in the direction of your higher time frame, or HTF, bias. This becomes your primary trigger to consider entering a trade. Next, you look for a market structure shift, or MSS, which indicates a potential change in the trend. After that, it's important to wait for the price to clear existing liquidity above or below your point of interest, or POI. This often signals that an imminent reversal could be on the horizon. Keep an eye out for liquidity sweeps. That's when the price moves through liquidity levels quickly, which can be a sign of a strong move coming. Monitoring how price reacts at the HTF POI is also crucial. Look for signs of absorption, where the market absorbs buy or sell orders, or rejection, which can indicate strong support or resistance levels. This gives you insight into potential reversals or continuations. Now, to get a clearer picture, you should move from the HTF, like the daily chart, down to a lower time frame, such as the M15. This allows you to observe the granular price action, giving you a more detailed view of what's happening at that specific point. When the price reaches the HTF POI, it's time to zoom in. Transitioning from the HTF to the LTF is vital for confirming your entries and avoiding premature trades. This strategic shift helps you fine-tune your timing and improves your overall trading discipline. In summary, this transition process, going from HTF to LTF, ensures that you're trading with confirmation rather than guesses. It's about patience and precision, making sure the market aligns with your analysis before you act. These LTF confirmations are crucial because they validate that institutional execution is actually happening in the market. When we see these signals, it offers us high-probability entry points, which is exactly what we're looking for. One of the key signs of a potential reversal is strong candlestick patterns at the point of interest, or POI. For example, rejection candles or engulfing candles can indicate an immediate price reversal, signaling that the market might turn around soon. Another important confirmation on the lower time frame is the formation of new order blocks or fair value gaps after the market structure shift, or MSS. These formations help us refine our entry zones, giving us more precise levels to consider for entry. When we see an order block or FVG forming, it suggests that the market is establishing new areas of support or resistance aligned with institutional activity. Additionally, a clear break of structure on the lower time frame that matches our higher time frame bias can be a very strong confirmation. This means that the market's recent moves are in harmony across different time frames, reinforcing our trading thesis. Sometimes, price will move past a liquidity area to activate orders and then reverse. This is called a liquidity grab, and it often triggers institutional players' orders before the market turns back in the intended direction. Recognizing these liquidity grabs can give us an edge, as they often precede significant moves. Finally, all these lower time frame confirmations act as final checks before we execute a trade. They ensure that our entries are aligned with the institutional order flow, which maximizes the probability of success. This LTF entry confirmation model is about combining these signals to make informed, confident trading decisions that fit within the bigger picture of market structure and flow. Now let's talk about your risk-reward ratios. Aim for a minimum RR of 1 to 2, but ideally, you want to push that to 1 to 3 or more. This helps ensure your trades are profitable over time. Next, when planning your entry, extend your targets to the next significant higher timeframe point of interest, or HTF POI. This allows you to capture larger moves and stay aligned with the overall trend. Pay attention to the HTF liquidity pools. These are the areas where liquidity is concentrated and can act as magnets for price. Identifying these pools on the higher timeframe helps you plan better entries and exits. On the lower timeframe, focus on the immediate structural highs or lows. These are your key reference points for entry and exit. When it comes to taking profits, always think about capital protection first. Define your maximum loss before entering a trade. This is crucial for managing risk. If you're entering from a refined order block, place your stop loss safely beyond its extreme to avoid getting stopped out prematurely. Similarly, if the price breaks outside the confirmed LTF structure, set your SL just outside that break to account for minor fluctuations and avoid false signals. Strategic placement of your stop loss and take profit orders is essential. Proper placement helps you manage risk effectively and maximize your returns. Remember, for your SL, placing it just outside key structural breaks or extreme points gives your trade room to breathe, while your TP should be set at logical levels aligned with your overall target. Keeping these principles in mind will help you trade more confidently and consistently within the smart money concept framework. Remember, in trading, clarity always beats complexity. Simplifying your approach helps you see the true opportunities more clearly and makes your decision-making more effective. When we spend too much time confirming every tiny detail, we risk missing good setups or entering trades too late, which can hurt our overall performance. Overanalysis, especially when we look at too many timeframes, can cause confusion and paralysis by analysis, making it harder to act confidently. Jumping into a trade on a lower timeframe before a clear market structure shift has confirmed the reversal or continuation is another common mistake. It's like trying to catch a moving train without knowing where it's headed. We need that confirmation to increase our odds of success. Similarly, entering trades without price interacting with a significant higher timeframe point of interest often results in low-probability setups, trades that are unlikely to work out. And then there's the mistake of trading against the higher timeframe bias. For example, taking a short on a lower timeframe when the overall trend on the higher timeframe is bullish. That's like swimming against the current. It's just more difficult and less likely to succeed. Avoiding these common pitfalls is crucial for consistent profitability. It's all about applying smart money concepts effectively, keeping our analysis clean, and sticking to the bigger picture. When we do that, our trading becomes more disciplined, confident, and ultimately more successful. Now, as we wrap up, remember to think like institutions and execute with precision. This means placing your stop loss and take profit levels strategically, ensuring you have a favorable risk-reward ratio in your trades. Managing risk effectively is crucial for long-term success. Next, we look at how market structure shifts are validated. When we see a change on the lower timeframe that aligns with the bias on the higher timeframe, it confirms we're on the right track. This LTF market structure shift, or MSS, acts as a key confirmation. Additionally, a confirmed liquidity grab on the lower timeframe is critical. This liquidity sweep indicates that the market is moving to clear out stops or trap traders, setting the stage for a potential move in the direction of the larger trend. Right now, the current price action is interacting with a marked higher timeframe point of interest, or POI. These are key institutional areas where we expect the price to react strongly, because they tend to be zones of high liquidity or supply and demand. With the price at this POI, we're observing a significant interaction that can give us clues about future movement. Remember, these areas are not random. They are strategically identified zones where institutions are likely to react. On the higher timeframe, we've marked a clear POI, which helps us establish a defined direction. This is essential for aligning our trades with the overall market trend and avoiding counter-trend setups. Finally, defining the HTF bias gives us a big-picture perspective. It's about understanding the overall market sentiment before we consider any trades. Before executing any trade, I always run through a comprehensive checklist. This is the MTF SMC trading checklist. This step ensures that my setup aligns with institutional logic, and it maximizes my chances of success by confirming all key conditions are met. So remember, thinking like institutions and executing with discipline is what separates successful traders from the rest. Stay methodical, stay disciplined,